Welcome, everybody, to the second episode and installment of our Keeping Your Seat at the Table educational series. My name is Charlie Bathgate. I'm the CEO of our operations here at Sangalucci, our family of operations here, and I'm joined by the founder and leader of TradingThePost.com, Ron Friedman. I want to say hello. Most of you, I'm sure, who are watching this probably know who Ron is at this point. If you don't, I highly encourage you to either go back to our YouTube channel and look at some of the interviews that he's done where he's laid out his life story. I think we've made those pretty accessible on our YouTube channel. His story is incredible, definitely inspirational for a lot of the people in our community. And then in the last series, or sorry, the first installment in this series, the Keeping Your Seat at the Table series, if you're wondering what Keeping Your Seat at the Table is, what that means, what it's all about, highly suggest you go back and watch the first episode in this series. It's on our YouTube channel. It's pinned to the Sangalucci YouTube channel. And we give you, in the first 15 or 20 minutes of that, we really kind of set the stage for what this whole series is about. So we won't rehash that here, but today, what we are here to talk to Ronch about is, we said one, but there's actually kind of two trades I think we really want to get into that were just fucking awesome trades from the year and really kind of good examples, I think, of a lot of the tools that you use in your trading toolkit, Ronch, to do what you do. And so that is the NVDA trade, and that'll be kind of the primary focus. And then we're also going to talk about some of what Ronch has been doing in Netflix. If you hear me referring to Ron as Ronch or Ronchero, all the same person. This guy, when he first joined our community years and years ago, his handle was Ronchero. And then we got to know him, and we realized, and we knew his name was Ron, so we call him Ron. But sometimes Ron feels like, I don't know, formal or something, and I'm like, no, Ronch. He's Ronch. So if you hear me saying Ronch, I'm talking about this guy on your screen. So Ronch, let's just like set the stage with this NVIDIA trade. Do you want to kind of take us back to when? I know NVIDIA is a name that you have traded for a while and you get a lot of familiarity with it, but like kind of when this trade started coming together for you, when it first started coming on your radar, and then we can just kind of walk through sequentially.
Yeah, sure. I mean, everybody has their own way of generating an idea, right? And I think for us, I specialize, not specialize, but I focus on a handful of names. For me, what I like about that is that it gives you familiarity, and it gives you a level of increased probability of success, or you find out quickly, I don't do well with this name, right? Like I don't trade this thing very well, and you kind of kick it out of your universe.
Sorry to interject real quick, but how big is your handful? Is it like a universe of 25 names that are in your rotation, or like fewer than that?
I kind of keep an eye on, I would say, well, the link to my TOS web, to my how I have my platform is available to our members. Like that link, our members can use that link, and I keep all the names that I kind of keep track of on the left-hand side of that. And there's probably 25 or 30 names plus some indices that I'm just kind of keeping an eye on. And we were trading a lot of, for example, Google and Amazon, and after they split, they just lost interest for us as trades, right? Just because they took the price down. We're options traders, so from that standpoint, it became less ideal for us to trade. So the stocks just kind of rotate in and out of favor. So I would say that on any given day, I'm probably looking at somewhere between 5 to 8 names that I'm trying to target. And whether that be a very short-term trade, it could be a matter of minutes, whether I'm looking for a pop or a fade, or it could be something where I see something setting up that's going to be a little bit longer term, where it could be, we might use options that expire a month out to capture a move, or we're going to try and look to see if we can find something that goes out further, right? Like different stocks fit different profiles. So just because I'm looking at like, let's say 5 to 8 names doesn't mean that I don't have others on the radar for different lengths of time. So
right.
It's a long-winded answer of saying 5 to 8 names,
yep.
right? But
5 to 8 names kind of core that are, and then there's other that are kind of circulating in there.
And they kind of, they come in and out of favor, right?
Right. Okay. Sorry, I interrupted you. So
no, you're good.
So it's kind of on a little bit on your short list you were saying, and then the
NVIDIA trade, just generally speaking, last year, for the last 5 or 6 years, NVIDIA has just been a monster, right? Like it's just been it was just a fantastic trade on the way up. And when we reached an area with the the S&P coming back in, it was, you're looking at the trend and you're trading in the direction of the trend. So one of the things that started to, we have a collection of tools that we like to use to identify whether a trade exists and what kind of that duration that trade is going to be. In the case of an NVIDIA, one of the things that we noticed and we still look for and notice is when there is insider activity. And by insider activity, I mean people who are just blatantly cheating. And who do I mean by blatantly cheating? Publicly elected officials who are using information because for them it's legal, for us it's not. Right. So those are some of the footprints that we're looking for. We knew good old Nancy was, hopping around in NVIDIA. So we're looking for.
I didn't realize that was actually part of the catalyst for this. Okay.
Yeah.
Word.
So we're looking for her, and we're looking for her trades, or what we think might be her trades. And then we have some resources where, and it's public information, you can go out and find when she has placed a trade. For example, she's recently has been purchasing Google. So both GOOG and GOOGL. So that's of interest. If you see something like that, that's of interest. So we know that she had been dabbling in that, and a whole host of others. I mean, she's probably the best trader on the street, to be honest with you, because
yeah.
I mean, if I
nice source of edge there,
I'd never miss if I had that info too, right? So so it's like, hey, dude, if this wave is big enough, will it hold more than one board? Probably.
Right.
So
right.
Those are some of the things we're looking for. So that was kind of how the idea came about, was, okay, listen, we recognize from a technical standpoint how the S&P is moving. We also recognize that there's some stuff going on. We know that
and when about was this, like, were you starting to zero in and starting to put on the position? Like, is
so on NVIDIA, the thing is, it was difficult because you don't have, this was later, right? We're looking at August when this started coming about. And this was, it's not at the all-time highs, right? Like I can't time a top, I can't time a bottom. What I can do is I can look and say, this looks like an area where we might see some resistance, or we might see some support in this area. And then all of a sudden, if you get to those areas, what happens is that, history kind of repeats itself. There are pockets of supply and demand. That's how our business works. It's not a science. It's part art, part science. So you're like, hey, over the last year, I kind of got sick and pissed about watching Nancy trade so well. And it's like, I can't believe that she's not still in this. I have suspicions. I don't know if I'm right or not, but I'm going to start to look. So back in August, as the stock is, like around 195-ish, 192-ish, somewhere in there, we're kind of looking at that. We're looking at the S&P 500. The S&P 500 is coming back up to areas of resistance, and it's not holding. And then we start seeing in our service, we start to see a lot of unusual activity in NVIDIA puts. So it wasn't just random. It was, they came for them further out with time, over and over and over. And it was millions of dollars that built up. That's notable. So I start comparing where the chart is at versus the activity that I'm seeing, and then how much room do I have to go for what I think has the potential to flush out, versus how much risk am I willing to take, or how much pain am I willing to take to the other side, right? So that was our thesis. We had to, ultimately, you don't have any idea when it's happening who's behind the trade or what their actual intention is. That's an impossibility. You have to make educated guesses and decide whether the probability is worth the risk that you're willing to put on the table. And in this instance, I was like, God, I watched this thing. I watch these people make money on this thing all the way up. I watch these people make money on the way down. And I think that this is the same group of people in here cheating their asses off again. And I want to be a part of it.
Right. So you saw that, and then you saw it was basically like put sweeper activity, right?
We saw a ton of put sweeper activity, and then we just started getting technical signals that we look for. We started getting the technical signals. We started buying a little bit close in. We started buying at the money. We started buying same week expiration, and we started getting a feel for, are we in the right spot? And then we had a day in, I don't know, it was like the middle of August or so where it gapped down, and it didn't gap down a big amount. It was like, call it 180-ish to like 175, but notable because that gap came after a lot of that put activity. And then it kind of consolidated a little bit. And it's like, okay, how long can I hold this? How far out can I go? I keep seeing the same type of put sweeper activity again and again. And that's what's keeping me in the trade, because even after it gapped, there's a rule of thumb. It's not a written in stone. It's a guideline, just like everything in this game. There are no certainties in this, but the guideline is, hey, 80% of the time, if a stock gaps, it's going to fill that gap. So you have 20% of the time it doesn't. And 80% of the time when a gap fills, it reverses direction. So I'm simply sitting in NVIDIA looking at it and watching the put activity come in. And sure as shit, a few days go by, it reaches a technical level, it pops and it fills the gap. And I'm like, okay, I have to add to my position because I have an 80% probability in my favor that once this little gap is filled, that we reverse. And the day after it filled, and we shorted again after that gap fill, the next day it opened at 180. And by the end of the day, it was at like 162. And we were just like, and that was what set the tone for us to be able to just stay in the trade and continue to roll down. And then all we did was apply some simple measuring tools to help give us targets. It's never hey, this is the target and this is the price it's going to hit. It's like, here's an area for a target. And why does it have that type of probability? If you go back and look at a chart, you'll see the gap I'm talking about in August. And then it did the same thing in right at the very end of the month. Same thing. It gapped down again. We were already in the trade. We rolled our strike prices down. So we put profit in our pockets and we just held on to that. And we just used part of the profits to move to a lower strike. And then boom, you get another gap, right? Like by the time the end of August rolled around, the stock had fallen from like 178, 180, all the way down to like $130 a share.
Yeah.
And we were able to catch it. We were able to catch it because of the different things that we see. And more importantly, there's no way that I could have just gotten into this trade and ridden it to its resting point, kind of, so to speak, where it's at right now. That's not something I can do. But what I can do is I can manage a trade and I can use profits to move strikes. Now, I'm not maximizing every dollar out of the trade, but what I'm doing is I'm decreasing risk and increasing probability as I go. So, it's when we catch those types of trades and we catch something in that type of environment, it typically works out really, really well for us. And, somebody would be like, well, what kind of a return? That's all relative to how you trade. But if you look at it positionally, and let's say, for example, you risked $10,000 on the trade, by the time we're done with the trade, you're looking at profits that are, 150, 250%. So they're very lucrative trades when you can find the right setup and you have these things that kind of roll into your pocket. And then if you can manage it, right? Now, if I were efficient and caught the top and caught the bottom, my return would be much, much higher, but that's just not reasonable, right?
Yeah.
So it was a really nice trade. It still is getting activity from put sweepers, right? And it's all the way back down now to where it was back in March of 21. So that's a significant amount of upside that if people bought anywhere on the run up, if they haven't adjusted their position, they're still sitting here looking at this saying, damn, I'm back to 2021.
Yeah.
That's
I mean,
it has a tendency to break the spirit of investors.
I'm going to do a really douchey thing right now that people who work in our business are probably going to cringe, but I'm going to make a surfing analogy. And I'm going to compare getting a really good trade to surfing a wave. But it's just because it makes a lot of sense. Like, really good surfers, one of the first things that they do is they know how to find good waves, right? They put themselves in a position to find good waves. They're not just going to random beaches and try and surf random ass waves, right? They go to the right spot. They track swells and everything like that. And as you were talking about your how this trade kind of came onto your radar, you're talking about Pelosi, you're talking about sweeper activity. This is obviously a name that you know really well from having traded it for a long time. Like, you kind of like saw this storm potentially brewing. That doesn't mean that you were like, I know for a fact that NVIDIA is going to 150 and I'm betting the farm on that, right? You were just like, this, based on what I look at, this could be happening. I'm gonna like put myself in a position. I'm gonna put my board out in that water and I'm gonna start, establishing myself. And then from there, you were managing the position based on the wave that came, right? And I'm curious to know, and that's a lot of what we talked about in the last episode, is like professional traders don't so much like set targets and just be like, okay, they're not really good at predicting what happens. They're really good at managing trades and taking advantage of and reacting to what happens and what the market feeds them, right? And this is just a perfect example. This is one of the reasons why we wanted to break down this trade specifically. Like, did you have days when you were managing this trade where, you're kind of, you maybe were buying and selling a couple contracts here and there, and then you were just like, all right, now is the time to go heavier, and I'm gonna triple the size of this position? Like, how did that?
Yeah, so just remember when I told you about the gaps. So there was a day where it gapped down, and then it kind of bounced around. It reached a technical level, like the 50-day moving average, and there was some other stuff in there. It got to that spot, and a lot of times what happens is market makers, and it is conspiratorial the way that I approach it, is I look at it and I think, okay, who's up to no good? I know that it's not a it's definitely a jaded way to look at things, but it's how the psychology of the market works. So that's a common it can be a common tactic to create supply and demand. There doesn't need to be a specific reason. You can create almost any reason for something to gap, right? And then just fill, because what happens in gaps, you get people psychologically worked up. So if you see all that activity and then all of a sudden you get this gap down, people who are very short term are like, score, I got my trade, I'm happy, they take their money, right? And then some people are like, oh, it gapped down and now it's going to keep going lower. And they trap those people, right? And then those people are the ones who are put in pain when they go back to fill that gap. Those are the ones that freak out and sell. That's whenever you hear somebody who always says, I always get the trade wrong, or whenever I get into this trade, the market maker knows when I'm getting into this trade, right? It's like, no, you don't see the game. So you fell into the same trap as you always do, right? And that happens, it repeats itself over and over. So it's very, very uncomfortable when you see a gap like that and it fills to put more into a position that you still think is coming back down. But if you know some of the rules, basically all you're doing is saying, I'm still willing to take risk at this area. If I'm wrong, the next day I'll tip my hat and I'll back away and I'll reconsider. In this instance, we saw so much other activity that even though they gapped down and then filled that gap back up, once they filled that gap back up, I already know 80% of the time, once a gap is filled, it's going to reverse direction. I've got millions of dollars rolling into puts. If I don't add here for an opportunity for a flush, I can tell you hundreds of times, before I figured this stuff out, where I would be the guy that would get sucked into, oh, now I shorted, but now be on the gap. And now I'm getting blown out because of the gap fill, right? I couldn't sit there through it. Now I'm looking at the trade and I have all this information in front of me. I know what the probability is. I know what I'm willing to risk in that scenario. I'm like, this is it. Put it in a headlock, right? And if it doesn't work, okay, fine. I'm going to take a loss. I'm okay with that. But if it works, I'm going to get paid really well. And it worked. And it worked really well. Thank you, Nancy.
Right. So when that was happening, there are days where you're just responding to obviously the events of what's happening, and you're like loading up the position and then, putting on more risk, piling on more risk. I mean, were you doing that? Two questions around that. One, for this specific trade, were you doing more like weekly expirations? Was it a little further out? Was it monthly expirations? And then two, were you looking at tape at all for that? For like, I don't know how much in this trade specifically you were like reading tape and getting into specifics of that.
I'm usually reading tape when I'm scalping. And for longer trades, I lean a little bit more on where something is at on a technical level and where activity from the put side is coming. And in this instance, when NVIDIA was going through its drop, these puts were a little bit further out in time. I think, and I would need to go back and look, I think I was 2 or 3 weeks out on our expiration because I wasn't looking at the trade as a scalp. I was looking at the trade, and some people like to say swing. Whatever terminology you want to use, I'm looking further out. To me, a swing trade is going to be anything more than 2 weeks out to, let's say, 90 days, right? So this is you call it a short-term swing, if you like. And all I'm trying to do is buy time because I'm looking at it from a bigger picture standpoint, and I'm looking left on a chart for an area where some support might be. And there really wasn't good support. And guess where we're at? We're at the level where there's actually more support for it historically. So this is an area right now where the stock is trading that has significance. If this area from a support standpoint doesn't hold, and I start to see like big activity again on put sweepers, people buying a ton of puts on NVIDIA, it's going to clue me in again that I might have probability. The only thing that's going to get in the way of that, it would be a catalyst event, right? Earnings, right? Or what was crazy also about this move and why I think so many people were so frustrated by it is that Nancy was in there, and then I forgot what the news was on the semiconductor industry. I mean, basically, if you look at the big picture, I went on a rant about this morning too, just in the semiconductor industry, you have the Biden administration turning the screws on China from a chip perspective, right? Like you've got 3 different tiers. And if you don't want me to go off on this, let me know, but I'm about to spin off. Okay.
Yeah.
So, and this is my thesis, and you know, you can agree with it or not. It's fine. It's just an opinion, right? Mm-hmm. So the facts that I do know is the Biden administration is putting the screws to China. And if you look at chips are like tier 1, tier 2, tier 3, right? Tier 1 are what? Cell phone servers, satellites. That stuff's all made in Taiwan, Korea, the US, Japan. Tier 2 is like for automobiles and the aerospace industry. That stuff all gets made in Malaysia and Thailand. Level 3 is kind of the Internet of Things types of chips, dumb chips, right? Like the chip that lives in your refrigerator to tell you you're low on freaking sriracha, right? Those are the types of chips.
I wish I need that chip. I need that refrigerator. Jesus.
Those are the chips that are made in China, right? So the intellectual property, the design comes at the tier 1 level, comes from the US, right? So if the Biden administration is putting the screws down on China because they're not going to let them buy equipment to make tier 1 or tier 2 chips, right? They can't buy the tools to operate the equipment. They can't build, they can't install, they can't operate, they can't maintain. Like that's an ecosystem of chips, right? And mm-hmm. what China does is they take those chips, they need those chips so that they can put that AI into their software. So if you don't have that for them, then the chip industry is going to sag a little bit, right? Because mm-hmm. they're losing a customer, mm-hmm. you know. Mm-hmm. But you know, I guess the thing that I like about it is I'm not a fan of autocracies, governments, and mm-hmm. I don't have a problem with what's going on, because you know, this is something that if it works, you have, and I'm not talking about supply chain interruption, or you know, that's a whole nother topic, right? Or the materials that you need to make the chips, et cetera. That's like a whole nother battleground. But you're looking at 2 to 3 years where, you know, this is the assault on their technological advance, right? Right. So right. Semiconductors, like you can't touch anything in this world without a semiconductor being involved. It's as essential to your day-to-day life as breathing air or putting gas in your car, right? Yep. Or plugging it into the wall so it has a charge, right? Yep. So this industry, and that's another reason why I like to look at, you know, the chip sector. It's just a good industry for us to look at as traders, and I think it's misunderstood. And if I can catch somebody like a policymaker cheating because they know that some type of announcement like that is coming, I want a piece of it too. If I elected you to sit in that chair and you're going to cheat your ass off so that you can live a cushy lifestyle, why the fuck can't I get a piece of that? I want a piece of it too.
Right. Yeah. I mean, I hear what you're saying. You have like a macro thesis here that goes back to what I was talking about in my wonderful surfing analogy about like spotting the best like surf break, like spotting the wave. Like that is part of how that shows up for you. I think one of the things that I find refreshing about how you trade and how you approach things is there are people who essentially trade almost entirely on that macro thesis, and they're married to those things, right? And for you, you're like, yeah, this is informing what I'm doing. This is putting it on the radar, but I'm not going to start pulling the trigger on trades until I see things from a technical perspective, until I see order flow that supports it. And you manage the position appropriately from there. I mean, are you with like, when it came to closing out this position, like when did you start when did you take most of it off? Was there what did you see that you were like, okay, now it's time, you know, we've captured as much of this as we're probably going to get?
Yeah. So like the way that I'll manage a trade is if I get a nice big fat move, like we had a nice big fat move the day after we added to our position, and it was just simply being in the right place at the right time because I had a gap fill, right? I didn't have tape telling me that was the right move. I had this idea, this thesis, the activity I saw, and then I had a technical event, which was a gap fill. And that was my signal to say, okay, I'm going to add. And then the next day you get a massive flush. So what do? I take my profit and I cut my profit in half, and I use that half to roll down in strikes and look for a more lotto type of a strike. So for example, I would move away from at the money strikes to more out of the money strikes with profits to say, I'm willing to take a little bit more risk with something I already have won. If it goes away, I'm okay with it because I still have half of that win. And that does happen. And to me, that's a victory. And that continues momentum and direction in the right place. I'm willing to take half of that profit and risk it. And if it happens again, it's rinse, repeat. Now I'm going to take half of that profit and I'm going to move to more lotto strike. And if it keeps working, I keep going. When it stops working or the trade starts to reverse direction on me, I shut it down. So I see how many rungs of the trade I can get out of it. And I think we got down to, we were like in the 130s and it stopped working. So we were able to, it ceased to be a profitable mover. Most of the juice had come out of it. And that's what when I say I didn't capture all of the trade, we got the move, but I didn't, go in there with $100,000 and walk out with $1 million, right? Like,
yeah.
we managed it. Like you're never, you can get those trades, but it just depends on how much of a risk you're willing to take. I like to manage it because I don't like to give profits back.
I mean, I think this is one of the reasons why when trading the post, when this approach clicks for people, they fucking love it. And it helps them generate so much like psychological momentum, right? Where you're talking about like taking profits off and then putting, 50% of what remains into and buying those lottos down. It's kind of letting it continue to roll. It reminds me, I hope everybody's had this feeling of being at around a craps table in Vegas where someone's on like a crazy roll and someone at the table's on a crazy roll and everybody's like not only made all the money that they originally committed to the table back, but they've made like even more. So everyone at the table knows that they're playing with house money and every single win is just like, are you fucking kidding me? This thing's going to keep going. Like, this is so fucking awesome. Like, this is just incredible. And you're like giving bear hugs to some dude who's, you've never met before and you're never going to see again. But you're like blood brothers from that point forward. And that, like, obviously I don't want to characterize it as gambling or anything like that, but how you are able to manage these positions is generates a type of like psychological momentum and takes the stress off in a way that I think a lot of like beginner and intermediate traders don't allow themselves to think about, like how to trade stress-free, how to manage a position so that you aren't worrying about stuff like that, how to pay for a position with the profits from the next leg of a position with the profits from the previous leg of the position. So I think that's really big. And, obviously we're big on psychology here. And it's one of the reasons why, I think you've had the success you've had. So I don't want that to slip by people. That's a big deal. Cool. Is there any other parts of NVIDIA that you want to highlight before we maybe pivot to a little dissection of Netflix too?
I don't know if I've got anything else specific on the trade. I just think that people, I think, get the wrong idea of, or have come into a trade with the wrong idea. I see so many traders come in with, hey man, I need to be in at this price. It's going to be full position. I'm looking to get out at this price. And just so much of trading is you've got to know when you're wrong and correct it. And when you're right, just like the craps analogy, you don't know really how long that's going to last. You have targets and things to look at and say, I think this is where it could go because it's been here in the past and it has good probability of that happening. But, things just don't go bottom left to top right. There's movement in between. And you don't want to get caught, especially trading options, in the wrong spot with the wrong strike and the wrong expo. Like that's just where people get so messed up. And I think so many people just hear the stories about, I started with 20 grand and I'm up 2.5 mil, right? Those stories are there, they happen, but there's some crazy shit along the way that they either ignore or they should have managed. And maybe they shouldn't have wound up with 2.5 million, and they should have managed it along the way, and they would have had less, but at least they would have managed it, properly. I always like to say a bad decision that is rewarded with a positive outcome is still a bad decision, right?
Yeah. So, I mean, this is actually one of the worst things. In all seriousness, it's one of the worst things that could happen to a new trader is to have a shitty decision get rewarded by some fluke in the market, and then they're basically chasing that. They're chasing that dragon, and they're sent the wrong signal, but because of the reward that they got, it's like imprinted in their brain neurologically as though it was right, and it can wreck people. We see that way more often than we see people, turning $20,000 into 2.5 million. So, I mean, I think for everybody who's watching this and who's like, okay, I'm pretty, bought in on the logic of what Ranch is saying and whatnot. This seems valid to me, but you're like, I wish I had some more details. I wish I could go underneath the hood when he says, we're looking at certain technical levels where, I wish I could see exactly what he's talking about in terms of when he got in and out at, on a chart and stuff like that. We have that information that is available. That's what members of Ranch's room, Trading the Post, get access to. The reason that we're doing the series right now is because we are doing a re-release of Ranch's course, his trade at tradingthepost.com. You can find out more information on this. I'm not going to do a long spiel on it, but you can find out what you will learn in that course at tradingthepost.com. Ranch teaches you his methodology. He teaches you how to do everything that he just described of how he managed this NVIDIA trade. He teaches you how to do that, plus a whole lot more. And we're also updating it. We're going to teach some live classes this time around that are teaching more specifically to how to apply Ranch's methods to this kind of market environment, which is obviously, pretty unique, and who knows what's going to happen in the future. So Ranch will be teaching to that. And then he's also opened up another account, which he's been gracious enough to do, that is basically going to be used just as an example for people with slightly smaller accounts. Ranch trades with a pretty sizable account. But there's a ton of people who come in and they're like, dude, I'm just like right at PDT. Some are a little bit below, some are just right above. And he's going to have some classes that are specific to how to apply these methods with that kind of account, the limitations that come with that account size. So that'll be great. I think extremely helpful. And maybe most importantly is you don't just get classes with this, you get access to Ranch's rooms for 3 months. So you get access to being with him every day, in the trenches, like watching what he does on a daily basis. There's people who were in the room with Ranch and who executed on this trade because they've internalized everything that he's taught them, and they're kind of managing this position on their own. They could do it without Ranch, in their ear. And then there's also people who are like, I'm making my own decisions, but I'm also watching Ranch. And he's like, when he says he's doing things, I'm making decisions based on that, right? There's a lot of different ways you can derive value from being in the situation. And I'll cut the ad there. For people who don't like the promotion,
fast forward, for God's sakes.
Yeah. We don't have ads. We give out a lot of free content. All right. A lot of free content on this channel. We got to pay for it somehow, right? This is not a nonprofit. So we pay for it through the people who are members of what we do. Okay. So tradingthepost.com, you can check that out.
I make my money through trading. Like
you make your money from trading. Yeah.
The room is me paying it forward. I enjoy teaching it, and I enjoy helping people who want to do this. I enjoy teaching them how to fish so that they have the opportunity to change their financial picture for the good.
I can attest to that. Ranch does not need to do this, but he fucking likes doing it. So lucky for you guys. Yeah. And last thing we'll say about the course, starting up the new session of live classes starting up November 1st. So you guys got until basically Halloween to sign up before that. Okay, let's talk a little bit about Netflix.
Yeah,
and how that's been going. I feel like this has been big too. So tell me about that.
And everybody is aware of what I was just talking about. Oh, there's, gap fill, and, there's no better example that's just sitting there right now, the Netflix since the beginning of the year has had two significant gaps. I mean, the stock was trading at $700 and then had funky earnings in January, early January of 22, big old gap down. And we were actually looking, we were in a longer term position on Netflix. And one of the things that we do in Trading the Post is we protect our positions around catalyst events. So that was, was it lucky? Absolutely. But the reason we were lucky is because of how we traded and because of where we were in the trade. We were in long-term, we were in a long-term position. We were in leaps. It was only a quarter position. The stock was still bleeding off. The earnings came out and it was it closed at 512 and then it opened at 400.
Mm-hmm.
And that was a massive day for us. So we scored.
Those numbers are just like zero. Yeah. Okay. Go on.
So it was, and no doubt about it, it was luck only from the standpoint of we were protecting the position. We weren't trying to trade the event. We were only protecting what we had. And because we were in that trade and protecting what we had, the return on it was as good as you're ever going to see in a scenario like that happening. So got out of the trade. And then we had another gap from its last earnings in of April of 22, not its most recent, but April of 22, another gap. Now, this one I wasn't in. This was just another, I was out of the position at that point in time. I was like, a long-term trade on this is not working. I scored on all these puts that I had to protect it. I'm stepping away. I wasn't in this trade. The next time it traded earnings, it was at 333, and then it opened up at like 243. So major significant gaps in the stock to the downside. So everybody is looking for the similar thing. Hey, 80% of the time gaps fill, right? So every time Netflix gets some wiggle to it, everybody is saying, hey, this is the spot where it's going to fill. In the back of my mind, I'm looking at it. It's trading in a range that every time it gets to the top of that range, it pulls the rug and people get sucked out of it. But what I do notice is that, hey, it trades up to here, it trades down to here. That's a channel, right? So I'm looking at it saying, let's see if we can identify a trade for this particular range of the stock. So one of the strategies that we use when I can't pick something for a directional trade, whether that's a shorter term swing or even a scalp, or hey, I'm going for gap fill, I use something called an iron condor. I'm basically collecting premium on the top side of the channel and the bottom side of the channel. And I have a way of being able to alter that trade and make it a directional trade. So I look at it, I look at a sideways pattern and I say, fine, I'll put an iron condor on. And when and if, let's say I get sweeper activity, let's say I notice major change in tape, Nancy buys it, you know what I mean? If that's the case, then I have the ability to make one adjustment and catch the direction of that trade, whether that's up or down. I don't care. If it stays within the channel, what happens is my position that I've collected premium on expires worthless. Now, we don't keep them until they expire worthless. We like to collect 70 to 80%, and then we tap out and we look to put the trade on again. So we do this week after week after week. So in Netflix, it worked for 6 weeks. And now we've collected money on Netflix where everybody else, not everybody else, a ton of traders have just been sitting there beating their heads on the wall saying, this is it. We're going higher. We're going higher. We're going to fill the gap. And it doesn't happen. Right.
Yeah.
Whereas what we do with our approach is we say, okay, fine, prove that you can fill that gap. And if that happens, we'll make the one adjustment we need to make to catch that direction, instead of being the guy in line at Starbucks that wants to talk about, I made that call. Right.
Don't be the
Don't be the guy in the line at Starbucks.
Don't be Starbucks.
If there's one thing you take away from the series, don't be Starbucks guy.
Don't be Starbucks guy.
Yeah, I mean, I think that is a really good example of yet another way to kind of, skin the cat, to use a cliche, and how you generate pretty legit returns in some chop markets, right? Yeah. Of that iron condor strategy. And I love the way you put it. If you're like, if it starts to move directionally, I can make one adjustment to take advantage of that, but you're still in you're not in an exposed position, sitting there like that.
Correct. I mean, the only way that you are is if you don't apply the strategy properly. That's where a lot of people, they don't have the feel or know where they should be putting their strikes. All they're thinking is, oh, well, this is, an ironclad channel and I'm just going to try and collect as much premium as I can. It's like, well, that's not the purpose of this particular setup. If it was a different setup and it truly was just stuck, then it's a different conversation. But Netflix is a stock that moves. And if you don't give yourself the right amount of wiggle room when you go to make an adjustment, you can really, really smash your face on a curb, just like you were, that 11-year-old riding his BMX bike for the first time down that giant ass hill. You know what I mean? And you hit that curb and that front wheel just freaking folds like a taco and your face is just on the freaking asphalt rolling down with the rest of that. I've seen so many traders think, oh man, I got this iron condor thing down, and they just get freaking pasted.
Well, as you've said a couple of times in this series, you are never going to be, you have amazing trades. I mean, we were talking about the NVIDIA trade, 150, 200% return. I mean, that's like over a period of, a couple months max. That's obviously an incredible trade. Anybody in here would take that. But you are never going to be the biggest, take down the biggest gain, the maximum gain possible in any trade. But one of the reasons for that is because you are never going to expose yourself to really significant downside risk. You're never going to expose yourself to that explosion moment. And I feel like, correct me if I'm wrong, but you've been there enough times yourself where you were like, never fucking again am I going to go through that pain.
I mean, if you have, and like with the scalps, I don't look at scalps like, oh, I'm going to make $1 million today trading a scalp, right? But if you've got the right account size and you catch a day like last Friday, right? Like last Friday, actually, was it Thursday? It was Thursday, right? Thursday, it went right to a level, the S&P did, that we've been looking for a very long time. And what was it? It was a gap. So what happens in gaps? It hit a technical level and it bounced. So, we cover our shorts. And if you're a big dog and you want to do something on a day like that, where you're like, I'm going to trade contra, I can, I feel like I can throw 20 grand at a trade, right? For a day trade. Like that would be a Lucci type of setup where he's like, I'm comfortable throwing 20 grand at this for a day trade to see what happens. And I'm okay. If I lose 10, I'll just take it off. No big deal. That would have been it would have been $100 and something $1,000 day if you did that. But those are like, that's the story that everybody wants to hear, right? Oh, I came in and I turned 20 grand to 100 grand today. It's like, okay, but like,
at what cost?
Who are you?
At what risk?
How did you get there? What kind of risk and everything else goes into it? It's not just show up and get money, right?
Yeah. Yeah. I mean, like, to put it succinctly, if you're here for like big time glory trades, sitting on the hood of your Lambo, kind of YouTube shit, then Trading the Post is not for you, but if you're here for like actual real trading and understanding how to manage a position and having some very legit returns, and you want to do the work, then this is the place to be. So one of the things that the Netflix trade also brings up for me is you always talk about being a local in name. And I mean, you kind of spoke to that with NVIDIA. Do you feel like that's the same thing with Netflix too?
I mean, it is.
And can you unpack what that means, I guess, for people?
Yeah, sure. So for example, think about this for a second. What the Condor allowed us to do, those who played it, it allowed you the time to get used to it. You're in the trade, you're in a Condor, you're getting used to the daily up and down. You're getting used to the chatter on Twitter. You're getting used to the stories and or the upgrades or downgrades and how they're impacting over this little trajectory, this window of time. The entire time in the back of your mind, you're like, I know I'm looking for a change in direction at some point.
Mm-hmm.
Do I need a catalyst event, or can I just continue to stay in here? And you learn how the stock is trading through that period of time, knowing at some point when you finally reach some kind of catalyst, probability, after earnings is it's going to make a move up or down. I think probability wise, it's going to break that channel. I don't know which side. And if it doesn't break the channel, I go right back to trading the iron condor again until it does find direction. And then I can just turn that switch and make that flip and catch the direction. So I think it's advantageous to be specific to a handful of names. If you're somebody that comes in every day and looks for, you're hunting the move there, that's fine. But I'm not good at that. And I'm good at doing these. I'm good at short-term scalps. I'm good at a longer-term picture and what strategy to apply to the specific picture. And once I can narrow down on that, I have much higher probability of success. It doesn't mean I'm always going to be right. There are plenty of ones that we've tried working with to catch those types of moves, and we're not able to we're not able to pull it together. That happens. That's just part of trading. But when we find them and they work, and you can get into the groove and you can learn the ebb and flow of it, it's very powerful, and it's really advantageous to your own account growth to be a part of those.
Yeah. Well said. Well, I mean, that's it. I'm sure that some people might have some questions. If anybody has a question in the chat, go ahead and drop it. But, we covered a ton of ground in this. So appreciate you taking us through this, Ranch, these two trades. Obviously, congrats on taking them down. And next week, I'm very excited for. We got someone who is a special guest who's going to be joining us for the next conversation, who I think is going to be a really good perspective for people on how somebody else who isn't Ranch uses a lot of what Ranch does and what he teaches, and how he approaches markets, in their own trading, which could have some, I think we'll give some really good insight to a lot of y'all out there. So whether you're considering, becoming a part of Trading the Post or not.
I agree. I think it's better to hear from somebody else who's actually had to do it themselves, as opposed to me sitting here telling you how great something is, right? I think it's better to hear from somebody else.
Right. Look at this dude. Nobody trusts this guy. Look at him. Come on. We can't trust this. Cool. Yeah. So that'll be Monday next week after the close. Yeah. Looking forward to it. Ranch, appreciate you being here. Thanks to everybody who joined in for this, and we'll see you next week.
Thanks.
All right. See you guys
later.